Hey, best people, back with you on another session of Crypto Sniper. So thanks for the comments on the HEX side of things. Still hoping that they overcome the SEC generally, but wow, we've got updates. Things are happening. And in fact, I'm at a state of quite high state confusion. So if you're coming for clarity, I'm going to throw a lot of interesting things in you, but I'm not necessarily going to be any better positioned to tell you what's happening. And that's not typical. I like to have a framing of reference. Boy, we have for you today a district judge, Jed Rakoff, who disagrees with the recent judgment that was issued by Nelisa Torres with regards to the XRP and the Ripple shenanigans that saw our lovely pump that we were really well positioned for and lucky enough to get that beautiful little 70% plus surge. So we're going to discuss that. That's point number one. Point number two, massive one on the dollar. Fitch came out and said, downgrade, downgrade. You get into trouble if you're a ratings agency and you do that. I'm sure they checked and mentioned and warned and said, listen, we're going to have to come out and say something. But it was a shock for us. They came out, that stopped a bit of dollar strength that was occurring. That was a primary concern. I started to worry a little bit that we're going to get a little bit too much continuance on dollar strength and that could have been very foreboding on crypto. Has that risk gone or not? I don't really know. We will have a look at the charts and we'll discuss that in more detail and some of the scenarios that might play out. So Fitch, that's point number two that we're going to be covering in this video. Then I will also be checking in with you and warning you that this week, point number three, this key week is a major data-rich week. Particularly the US dollar and what goes down in there. You actually had jobs openings that came out today, an important one, pretty much in line with expectations, and we undershot on ISM manufacturing PMI. Undershot on manufacturing PMI, 46.4 instead of a 46.9. That means that manufacturers are having less activity. That means they are making less, basically, and that probably points to the effects of all these interest rates biting. I will be showing you a chart that we have done. So point number four, we're going to go and have a look at some other economic indicators of great interest. So I will be showing you a number of charts on why we feel that you are in a deep recession, in this not a recession, and we don't do normal recessions anymore. And that is going to get disorderly and that you're going to be made to suffer pain for a lot longer before the cure comes out. That's right. So that's four big points. What else have I got for you? Also got a continuation from what we did yesterday on with regards to the SEC suing Hex, Pulse and Pulse Chain. I warned we will have a look at why there is real bad actors behind BlackRock, that they're the dark star, what's going down. We're going to refer to WorldCoin in a bit more detail and all the usual suspects and why and how we see the larger direction and the potential for Bitcoin and where it might be going and who is controlling it. Okay, let's get straight to it. So we'll go to the share screen and we will start with the federal judge said to reject the Ripple ruling on cryptocurrency. So what we've got is the perfect scenario here of obfuscation. That means you get one opinion out of one judge, you create complete discord, chaos, you have multiple unjoined up thinking with different elements going on. You have a SEC that's being aggressive and pursuing. Apparently, also, quick alert, the SEC will be chasing crypto influencers. Well, we've never shilled a coin. We've never taken money for shilling a coin. We've never suggested investment. We are traders, though, and at some points we've said, this chart looks going up. This chart looks going down. I surely hope we won't be targeted, but maybe we will. Who knows? But there will be many others that have been influencers that have suggested you buy something in the crypto space. I wouldn't want to be a US YouTuber specifically. Not that it stops them that they won't be attacking internationals like people like us. But as technical traders, I think we should hopefully avoid that one. So anyway, while we mention that, so Judge Jed Rakoff disagrees with Judge Torres, who ruled earlier that Ripple Labs cryptocurrency isn't a security when sold to the general public. She made quite an interesting ruling which kind of split how you handled it. She said, general public, not a security. It is one when you do institutional sales thereof. This judge, who is overseeing the Do Kwon, you remember that character, that's right, Do Kwon, one of the many rug pulls, he's the rug pull from Far East, Terraform Labs. He says there is no distinction between public and institutional sales. So one doesn't get to be a security and the other not a security. They're either both not a security or they're both securities. And in some senses, even though I don't think that bodes well for crypto, I kind of agree. I don't think channel should matter. I think what the item is. So they should hopefully rule that neither are securities, but I'm not sure we're going to get that lucky. So he's a bit of a back to square one feeling after the success that Ripple would have had in its particular case. Now you get a different judge making a different decision, which now leaves the SEC, instead of being the outright loser generally, saying, well, we were just unlucky because we had a bad referee for this football match on a different field, a different time, we might beat you. So that leaves them thinking maybe a retrial, maybe trying something else. Who knows? I don't know the legal processes. If you happen to know, tell us what could happen next. Can they challenge? Can they refile? I don't know. You go and let us know in the comments below. Good. So that's the first one. Then let's pivot to the dollar. So a big part of crypto is the fact that it is anti-dollar. Along with the rest of the anti-fiats, which is also gold and silver, which is the God market gold of all anti-fiats, Bitcoin, the God market of crypto. And essentially we had, quite interestingly, during this week when the dollar had actually rebounded quite strongly, we'll be going to the Dixie chart in a bit, because we called Dixie 97 and we said you'll get a technical bounce at 100 when you run the 100 level. It ran the 100 level, and then instead of just getting a small technical bounce, it kept on coming. It kept on coming all the way back to our funnel. That chart comes soon. So Fitch comes out and downgrades US after debt limit stalemate. Boy, point number 5 I forgot to tell you about after all our charts. Key debt number coming out. So we have to actually talk about debt. Let's talk about debt. We are in a proliferation absolute mania. And in actual fact, this tweet that came out from Lynn Alden, I think it was. Let's have a wee look. I'll be showing you that one in a bit as well, but that's not the one I'm looking for. Puppy Dogs and Licks by Lynn Alden. The Treasury's new guidance today is that they want to borrow checks, notes, says Lynn, shuffle some paper. Wait for it. This is just for the second half of this calendar year. Not an annual. Hey, we're overspending a little bit. We need to put this on credit. No, a semi-annual. So this is for, clicks the document, July to September, and then the remaining of the year, October to December. And they want to borrow 1 trillion for the next quarter and 852 billion, which is, I think, a little low because they're hoping that everything gets better and tax receipts goes higher and everything. You know, the further out they go, the more chance they have to get optimistic. 1 trillion during Q3 and 852 billion, which is 0.85 trillion. So altogether, to take you to the end of the year, 1.85 trillion for half a year. 2 quarters, and you're knocking on the door of 2 trillion. My prediction is that you'll get very close to the 2 trillion number. You may even bypass it. Any wonder why a rating agency that wants to hang on to even a shred of credibility, don't forget how they were coerced, went to sleep on subprime, never said anything, didn't want to downrate, they would lose business if they got too aggressive on the downgrades. Yep, the ratings agencies, the co-conspirators of the great subprime robot signing, mega debt splurge, ninja loan specialists, those guys are even trying to hang on to credibility, and they downgraded America's debt. They say, you're not good for it anymore. The firm cited repeated debt limit political standoffs. Yes, indeed. All a bit of a showmanship that didn't really lead to much in terms of any form of spending constraint. US government debt is the bedrock of the global financial system. Some Wall Street analysts warned that a downgrade could drive up costs on everything from municipal debt to credit cards. Yes, the good news is Uncle Sam plays fast and furious with the credit card, but your debt goes up and you pay for that fact that they are splurging. Foreigners need to buy ever more debt, or the Fed itself will have to monetize. China doesn't want to accumulate anymore. Neither does Russia. You know what we did to them on the payment SWIFT gateway. Guess what's coming, my friends? The debt splurge is absolutely accelerating. So if we get anywhere close to 2 trillion for the second half of the year, understand annualized that is borrowing for over expenditure. Over expenditure. This is, hey, less our incomes. Annualize that and it's almost 4 trillion a year. Imagine doing 4 trillion next year. I mean, it's quite feasible. It's quite possible in that you're spending X and you're only getting in X minus 4 trillion. I mean, it just isn't good math. That's a big ass credit card. So again, trillion people, very quickly, 1 million. If you count to 1 million, it's going to take you, yes, how long will it take you if you say one number every second? It's going to take you 12 days. Count to a billion, 1,000 of those 12 days, chunks, 1 billion, 32 years, my friend. That's how much bigger a billion is to a million. 32 years compared to 12 days. Not even a fortnight. Not even a fortnight. Now a trillion is 32,000 years. 32,000 years, my friends. Who knows what this planet was doing and how high the sea levels were back then. Probably roughly where they were today, but anyway, who knows. 32,000, wow, 32,000 years. I mean, that's how long it's going to take you. 1 trillion, so 4 trillion, 4 times 32 equals 128. Okay, it gets ridiculous, but you get where I'm taking you. So that is the Fitch rating agency downgrading, which put a stop on the dollar just as it was getting into our funnel on the dollar index. Let's have a look at that. It's time to refer to the charts. Let's go Dixie. We'll be coming back to Bitcoin. Dixie. So our scenario was for a 97 run. Boy, oh boy, could we be wrong on this? I don't know. It could be. We've got a very heavy data coming up. So employment stats, live trading day with us this Friday. Check the Twitter for the link profile to join us for live trading day. This is a huge data intense week that is coming out, apart from Fitch coming out and downgrading the dollar, apart from a judge contradicting a previous judge in the crypto markets, apart from the fact that we just learned that you're going to have to borrow 1.85 trillion to get through one half of a year. Apart from all these unscheduled events that are coming, you have the tomorrow being Wednesday, and by the time you're watching it, Wednesday it will probably be, you will be seeing the ADP number, which is a proxy for the eventual non-farm payrolls number that comes out on Friday, about how strong that labor market is. Now, if that number comes in under expectations for a second time in a row, that is going to point further to the softening. That could weaken the dollar, and maybe we drew a rally up to here from the 101 and then a down leg, eventually making our target, and in actual fact, rally, it's returned all the way to our funnel. But on the news of Fitch, you got the shooting star. Boom. However, we are now starting a new day and there's a second attempt to go deeper in that funnel. We will see if that stands. You may get a second shooting star as it sells off as we start getting into the ADP number. Do we pull back, or will we blow off past last month's non-farm payroll number, which was the perfect short on the dollar? That sets up this break, eventually the traditional entry that we typically have to the 100 run. So what is going to happen with the dollar? Any of a number of possibilities. And as I say, often I have a bias and a view that I am sharing with you right now. I don't know. I'd probably bias slightly towards a bit more of the dollar softening coming back down. But yesterday, I thought there was a real chance that the dollar might get a little bit of a surge. And then pop, Who knows what happens? Capping the dollar, out comes Fitch, out comes that deficit information, and suddenly people go, dang boy, that's a sure big chunk of debt that you plan on issuing, and that ain't good for your currency. So what's actually happening on the rate side in bond land? Because this is debt. This is debt, my friends, and debt issuance means more debt issuance, and it means more interest to pay, especially if your interest rate policy is going higher. So what is happening? Debt goes down in value. We have upside HVF structure here calling for a 4.74. Yes, many people said you're never going to see that on the United States 30-year government yield. This is the interest rate paid. As the interest rate on this goes up, the value of that bond goes down. There's so much of it. It has to go down in value. That means rates have to go higher. It's not about whether you can afford them. You can get crushed. You can get a recession. How many times have we warned on this channel and the Market Sniper channel? Are you subscribed to the Market Sniper? For the traditional markets, maybe not. Also on Twitter, we have warned repeatedly that rates can super spike. Why? Because debt has to be totally devalued away. There's too much of it. They can't afford the interest payments. Of course, they go up when the rates go up, but you can blow off into a melt up and a collapse. And who would have known? Black Swan Day, a la Greenspan, Now we have new system. It was a shock. The dollar hegemony cannot happen again. We've got this whole new system on the blockchain, transnational, and we'll touch on our friend Fink a little bit later. So what you're actually getting is higher rates here. Higher rates. So that allows the dollar to stay firmer because the debt is devaluing naturally. If the rates start to come down, what ends up happening is the dollar has to devalue because the perception is that you're no longer going to get better yield in American money than you would get somewhere else, somewhere in Euroland maybe, etc., etc. So the bond market is key because this dollar is borrowed into existence. There's also the 10-year yield. The 10-year yield also just made a target, came all the way back to our funnel, bounced and went all the way back up. Volatility on VIX is much, let me say this again, the volatility on the bond market move is much higher right now than the VIX on the equity market, and the bond market dominates. Equity markets, oh so groovy, everything up and fine, until it suddenly isn't, my good friends. So this is your volatility here, and we fear also potentially a big W-type structure that is in existence over here. Could see you going to in and around the fives. That would be very, very destructive. And you are again playing footsie with this key blue line that you see in teal blue. You guessed it, 4%. You guessed it. That particular projection takes you to the doorstep of the next logical round number. That's how people move. They get scared of round numbers, like gold in 2009, bumping up against $1,000, bumping up against $1,000, melts up to the 1,900. Now we've been trading just through the 2000, just through the 2003 time. What's our target? 2,900. That's how it goes, my friends. That's how it goes. Key round numbers, pegging, derivatives. That is what happens. The big derivative markets are at the key round numbers, and it happens the same with the debt markets as well. So that is a little bit about the debt markets. Interest rates likely to go firmer. But hold on, if the non-farm number is an undershoot, dollar goes down. If the non-farm number is a meet or beat, rates go up. Rates go up because the labor market is so strong. We can afford to keep tightening. Nobody's suffering at all. They aren't squealing. What's that noise? Oh, it's them singing with joy. Okay, more rates, please. Crush, there's nuts in the vice. You know what I mean? That's how it goes. Okay, so that's the debt markets that we've done for you. Let's go back to the data that's coming out. So the data that will be coming out, which makes this such an unpredictable week. And I've been a jack in the box, I have to admit, not been particularly calm. I was concerned for crypto, and then that dollar was going to run. Then dollar got stamped on, and then I was like, okay, Bitcoin is running. We will be looking at the Bitcoin chart shortly. Bitcoin is running. Why? Because this judge has reflected strength on those that are already cleared from the SEC that aren't part of that XRP securities ruling. In short, Gaines's comment that Coinbase should only have Bitcoin on it actually has unleashed Bitcoin, and we'll show you that Bitcoin has actually been getting the bulk of the money out of the move today, and that the rest of the alts kind of got a little bit of a bid to a point, but some of them are still pretty soft, especially not particularly helpful for XRP and XLM that were cleared in the case. Okay, so here's when the ADP number comes out. That's the time for you. You'll be looking at it 7:15 in your morning of the Wednesday. It's probably in and around this video's release, so you can go and check it straight away after you see that. And then Friday, you can join us. Remember, go to our website, themarketsniper.com. You can book it. This is how it looks. I'll even show you super quickly. Themarketsniper.com. Themarketsniper.com. Yep. There we go. Oh, it doesn't even remember me. It doesn't love me. Oh, you don't remember my stuff. Over there, and that's what you'll find. Site can't be reached. So go and book. You'll see a ticket over there. Maybe it would help if I put a full stop in the right place. That's why it never found me. And you will be able to book for our live trading day on the Friday. Here it is over there. You can book a call, free trading courses for you if it's a first time. And in terms of results, they're also there. And live trading day. Where's live trading day? Check it out on the Twitter funnel. I've just shown you the website for no reason. I don't even know where it is on my own website. What a muppet. Anyway, so let's go to those charts that are showing you key things of great interest. Okay, bond market versus treasuries. So I've made this point that the volatility is coming in on the bond market. This is the structure of money. This money is borrowed into existence. The bond market and the FX market go hand in hand. They're both huge, and you borrow money into existence. Right now, you've got the NASDAQ doing that in white, and you've got the bond market doing this. In fact, we remain a short. We're not currently short, but we say stay short on the likes of the ETF long bond market fund. Let's show you that, by the way, while we're here. TLT it is. The name that was skipping me. Let's just show you this again. The long term treasury. It is kind of a long distance, 30-year plus, 20 plus year EDF. This is the one that we called for some time a major head and shoulder reversal with this ascending upside HVF. That was the down. We called for that right shoulder. It was also a down. And then you've been in the stall box on this period pretty much since the rally after making target. You see, you make target, get a minor dip, and then you've been in a progress decay stall box. As ever, we always say your midpoint, which is your locust burger with all the World Economic Forum bugs, is sitting there, and you got your rising wedge into that. That broke you then down, and now you're spilling out of the lows of the box. See the midpoint there? That's it. That's how we carve it up. On the lower time frame, it would have shown up maybe a tiny bit better for you. So let's do it again for you on the daily. But this is a breach of the downside. You can see that resistance that was very clear, and you can see this failure to get past the midpoint in this last attempt here. You did not wish to eat and consume the bugs, and as a result you turned away and left that nasty little coffin pod that they want you to live in. There you go. Breaking to the downside, long-term debt. In short, as we've continued to say, debt must deflate. There's too much of it about. And what does that 1.85 trillion and everything else tell you? There's going to be a whole bunch more of it about. Coming ever faster, thick and fast at a parabolic rate. The higher the interest rates, the more interest you must pay. So that was that. This was the difference between the NASDAQ and treasuries. In short, one, runaway low vol bull. The other one, as I'm just showing you now, in one of the proxies for debt, trading through new lows. So treasuries, US 10-year treasuries, give him a follow. Tavi Costa, good guy, often posts interesting stuff. Worthy of a watch. NASDAQ also going up. There is a divergence. Which one is the problem? Who lies? Buy the damn dip was always good for both bonds and equities throughout the 40-year bull market that ended, according to us, March 2020 for the debt market, and the gold-silver ratio turned as well, which is the beginning of sound money starting to reinforce. However, equity markets There's no other game in town. We got to go into equities. They've continued to go muddle on. Yada, yada, yada. Don't want to hear about deficits. No, no, no. All good. Of course, there is an inflationary fact, which means anything that gives a yield will go up on a basis of diminished dollar buying power. So that is a little bit of a thing that does keep a bit of a bid under equities. They don't have to be perfectly aligned. They give future earnings. But they are being deflated in dollar terms, so that multiple is getting a bit too steep. Okay, so what about this? This is another one of Tavi's tweets, and this one I particularly like. So it's the difference between corporate bonds, so corporations, versus Fed funds rates. So if you put money with the Fed, can't quite always do that. You can buy government bonds, of course. You get a certain interest rate, and you get paid more on corporate bonds. We've highlighted that junk debt should have re-rated significantly lower. However, the control structure, as they're known, do not wish to see the debt markets even on the fringes, the junk debt, the high yield, crappy companies debt, get unruly, because they know it leads to contagion and will eat into the mainstream debt. And in actual fact, it's all junk debt now, just to varying degrees. So the yield between the corporate bonds, because they're being supported, particularly the junky stuff that hasn't gone down, versus the Fed's rate is getting ever narrower. You used to get paid a premium for getting a dodgy customer who might not make his payment. Now that premium is being eaten away because nobody wants to pay the higher rates. And by the way, what is he highlighting, that Tavi's highlighting, is that over here, dot-com boom, look at the white line. This is the equities white line, which is typical of a depression stroke recession. You see that extreme low where you're not paying enough? That's up top there. Here's another extreme low. Guess what happened there? You guessed it, 2007, 2008. That is your GFC. That's your dot-com boom. All your major crises and villains are here. Then you carried on mounting up. To maintain this, the premium continued to decay after a massive spike. That was very damaging for junk. And then, of course, you got the events of 19 going into 20. That was, of course, the name that you may not mention, March 2020, right the way through, but ended up in you not being allowed to leave your apartment very long and being encouraged to take experimental medicine that was designed to do rather ugly things. And as a result, you got a short, sharp correction there. However, it quickly was glossed over. Don't worry, the no-pain economy came and offered 6-7 trillion. Fluff, lots of checks for everybody. Go. Pumpamentals return, surge. Everybody buy high-yield debt. It's going to keep paying you amazing rates and be kept afloat with all this cheap money. It started to correct down. You had an echo bounce over there. You are now lower now in terms of what's being paid by corporate bonds over the Fed fund rate than any of these previous crises. Let me state it again. You are right now lower in the difference between the Fed's fund rate and the corporate average rate that is being paid, which has typically been a major indicator for a complete collapse both in the equity markets and, I'm afraid to say, crypto. This is a crypto channel after all. We're talking about a lot of things apart from crypto. I'm trying to improve your understanding of the global world and how it all works. Is not good for Bitcoin, not good for Ethereum, not good for crypto generally when you have these major crashes. Of course, you won't know anything about that in 2001, 2000. You won't know too much about it of GFC because Bitcoin was only just created there, and Bitcoin had the single largest equity bull market ever created to enjoy, to hyperinflate in value. And then it had the smallest one. It's encountered the smallest of these crises, and it fell, my friends, from 10, 11 after a run up to 14,000. It fell from 10 or 11,000 all the way down to sub 4K. It traded technically sub 4K on a number of exchanges. So be warned, that was a 60% haircut on the events that quickly saw pumpamentals return and brought us back up to the 10K mark very shortly thereafter, only for the first cup gold nugget mega move, as we had always suggested was likely to happen. So that crash, which was also part of our oil short gold long, that's again something for the market sniper, go and watch it. So all of this happened And now I'm saying to you, look at the scale of that dip, look how extreme low you are, and where the stock market is. This stock market has still not surpassed the previous high, the S&P 500. However, we are brewing an ever lower, and this is, again, debt markets are key to showing you what comes next. Do you think it was good when the stock market crashed? No, everybody chases liquidity and sells everything off. It's a problem. And this started to make me concerned for our reversal that was losing much momentum, going super low volatility. Could there be a downside spill, I wondered. And that is what I shared, which is one of the reasons why I'm the most conflicted I've been in a long, long time. Because the demand-destroying event we referred to looks closer than it's ever been, in my opinion, right now. That's right. Let me show you something else, one chart of my own. That's the big chart, by the way. I should have drawn on the big chart. Look how much bigger and nicer it is. See that absolute low there? Lower than the GFC, lower than 2001, and you experience what happens to crypto with that single event, and the taps came flooding in here with 6 to 7 trillion. Oh my golly goodness. No wonder you got the blow off that David Hunter first failed to notice, all the way up from there to there. And now you are making your move higher. You've yet to take out the previous high. You are already at significantly lower lows. And there will be continual need to deflate that debt and to continue to raise the Fed's funds rate, and those corporations will not be able to continually to escalate a fat margin, and it's going to continue to thin, in my opinion, until crisis hits. Why? Because it's a payment too high that they cannot afford. Anyway, to another macro market indicator, where she blows. Let's have a look. There was Lynn. Oh, that's our schmucks over there. So let's go back down to this one. So this was a major indicator that we've discussed ourselves. Let me get my tweets here. And it's palladium. It's the industrial metals of palladium. Now the industrial metals, this is our chart that we superimposed over data that we got from, I'm trying to remember the website actually, passes me, skipped, sorry. This highlights a precious industrial metal, a high cost industrial metal, palladium, part of the platinum larger family, pretty rare, used a lot industrially, particularly in exhausts, etc., etc. This is your recession chat that you're getting from your friend, the crypto sniper. And why are you hearing about palladium and the rating agencies and everything, and we haven't even yet looked at the Bitcoin chart? Because you need to understand macroeconomically where we are, because this is the great macro game. And I'm here to show you that the 80s crash that saw the end of the 70s, that was the cost of the Vietnam War basically, and the debt, and everybody calling America's bluff and saying, you're not good for it, bud. We would like our gold, please. Thank you very much. You can have your dollar back. That caused massive stagflation. The whole era was stagflation. That was a terrible time for equities. It was a terrible time for asset prices. The cities were grimy and grim, and all of this happened, and it was a major recession. The grey lines are showing you recessions, and you stumbled from one recession straight into the other. I would say that these recessions are shown to be rather thin. Remember, the Bureau of Stats doesn't like recessions and don't like to admit how much part of it. They often start even closer to the top and they run all the way. I would say that's one big recession that went in there, and stagflation. Then you got the 90s. George Bush, read my lips, no tax increases. He got chucked out for cocking the economy up, and Clinton got on board. Again, a fatter recession than it showed. It shows, again, the sell-off in the palladium price. This is palladium's use. But there is an inherent natural inflation, so it's trending up generally. But these sell-offs tell you a lot. The dot-com crash was huge. This is why I continue to assert that actually there was probably a depression, all told, for America that never got counted. So many things went bust during that period. There was so much fluff and stupid money around, and that breadth of recession is far too small. Again, a lie of statistics, in my opinion. Far greater, longer and harder, but you get lies, damn lies, and statistics, and that's how it works. Then you've got the 8-9, which is more properly resented, and that was called the Great Recession. because they were forced to have negative numbers. It was so abrupt and violent to the downside. Note, it didn't have the scale. This is palladium's price collapse. Didn't have the same scale as the dot-com boom did during all of that. Then you got the rally, and then we got the smaller correction that was part of the Shanghai Accord of 2016, which is when China maxed out its credit card. They were creating heat in the global economy from the base lows of 2009 all the way through to 16, and then they went tilt on the debt. That's where most of the craziness had already started to happen, and they started to have real issues. And all the world monetary leaders got together, and then they had a little chat, and then had no press conference, didn't say what they agreed, and suddenly all the problems went away. Or so you think, swept under the carpet. And then the not recession. So you had ever so tiny little recession here. If you believe that, let's just highlight this as a point. That little grey band, as a ever so tiny little recession, happened to be the total world being shut down, all small businesses ceasing to operate, everybody locked up in their goddamn homes. That's what they think. That's what they think that was in recession terms. That was the seminal end to the bond bull market. That was the seminal end to the gold-silver ratio. That was what dipped Bitcoin all the way from 10s and 11s right the way down to 3,990, whatever it was. So it was pretty intense. But don't worry, friends, we came back with 6 trillion, and you are now here. You are now here. Now, there has been some substitution back into platinum that ended up cheaper than palladium, but you have fallen this far and you still don't have a recession. By the way, I put in these grey boxes for the Shanghai recession. There was none in there at all. And I am putting in your not recession, because labor market red hot recession for this period right here. That is another reason why demand destroying events are on the way, are coming. It is not far away. And that is a concern for crypto and Bitcoin for me generally. Yes, sir. Yes, sir. 3 bags full. So let's go and have a look at how he did with that series of events that went down. In fact, where are we? Let's go here. So actually the top performer of the big caps right now is in fact Bitcoin. That's had a rather nice little rally. I'm going to switch the eye off there so we can get a nice clean rag. Here's my problem with this overall structure now. It's taking a bit too long. It made a marginally higher high. I start to get concerned now by the period of gestation. So we have something we call a broadening structure. You want to learn more about this and everything else that we do, you're welcome. Just go and book a call on themarketsniper.com. Show up, be courteous, and someone pleasant and kind will give you a full demonstration of everything without any further obligation, and assess your suitability as to whether you should be with us. So there's a channel in there, but of greater concern is this. You've only made the half mark, or split as we tend to call it, on this particular impulse. And often surges and sell-offs come in threes. 1, 2, and 3. And the middle one is often the biggest. You kind of got a little wind up there and a little bit more. So actually it ended up there after half a breath. And this one was around there. So the middle one is often the biggest. It's a bit like Elliott. And then the fifth one is often the smallest, and it was. And we have retraced quite a bit. So we are bumping up against what we refer to as a basing, ascending grind line in a channel that was up. Don't forget, we also have our blue neckline. We haven't gone away from that. We're on the dollar here. It's around the 25,000 mark, roughly there. In fact, I wanted that to be blue and it wasn't. So let's try again. 25. Okay. And that was our right shoulder. And we've told you this was all ahead. But progress has been somewhat slow of late since the breakout event, which was super strong. Don't forget, we got you in on the 19.9 and the 24.9 over there. But since then, a little bit of a falling wedge. Have we broken a falling wedge? So let's have a little look. That's your channel number 1. This is a key area. If Bitcoin falls through this and we have dollar strength, this could be disorderly and bring you back down to the magnetic line. and that's a slight concern when you're dancing with this. In short, by now we should have surged and moved up, and the fact that we only made the midpoint shows that there's a real slowdown a little bit afoot on overall progress to me. So there is an element of decay now that, given the time frame, is a little bit of a concern. Let's drop down to those lower time frames for what Bitcoin is truly doing. We said to you a couple of times we still expect a bit of a surge effect to materialize at some point. And as I say, I went into fear mode, and I will be telling you why, and why it involves stable coins in a short mode. So I actually thought, damn, I don't trust this. I might even sell all my investment. And I said, it's good to get totally square. I'm not sure I like what's happening. But right now, since that dollar kill message, it was round about here that I was in it, since the dollar kill message, you got this breakout on a falling wedge. But note, this is turning into a shooting star. You actually had quite a few little mini surges with lack of follow through. Yes, you took out this previous level. Yes, you have broken out of the falling wedge. And it's natural to have a pullback, but I wouldn't chase in at the top here. You would only end up potentially eating a drawdown on a revisit, which could come some way down, or it could in fact spill and break that bagel line that we drew for you all the way there, and which would mean dollar strength. So there's a data heavy week, starting with the day you're now watching this video. This is Tuesday night for me, far west I mean, so for some of you you'll already be asleep or getting up soon, and that's a concern. So if dollar got strong again and pushed back up, this could push this a lot lower. So there is some signs that there is some fragility. However, if it stayed on the falling wedge and just as a small pullback, it then could work its way up. However, we need some real momentum to get a proper move beyond that high. That high, as I've highlighted before, was only marginally higher than the previous high. And I don't tend to like that. Let's go to the 12 hours so we get them both in. I don't tend to like that. There you go. That's it there. Let's go back to our blue, in and around there. So much time and so much little extra gas and so much trauma going down, 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 down. So this falling wedge might just be good for a little bump, but it could decay. And you could trade lower, or you could just get a return move before going more. There's so much data to come. I'm not even going to try guess. Hence why I said to you, often I put forward quite strong biases and say exactly what I think and where we're going to go. And right now I'm warning that it's just that kind of a market. Okay, so we've covered quite a bit. I'm going to cover something else with you. This was the threat I saw on Tether that saw me think, hang on, I don't think I like this. I might get out completely. So, are you ready for this? I didn't warn you this was coming. And this is Tether Dominance. Now, there's a couple of things that could make drama in Tether Dominance. There are a couple of things, in fact. Let's have a look at it on this chart over here, bigger time frame. And that could be other Tether fails. So many of you might have noticed that BUSD had quite an interesting time. Binance has been certainly attracting the wrong kind of attention and is certainly getting persecuted. The centralized exchanges seem to be fair game for the SEC, and harassment and lawsuits and everything are being served left, right, and center. So this was a interesting structure, base plated low, and then an eventual rising wedge high, and a spill down to here, and then grinding a little bit lower. So I covered this in detail with the community. What's the problem with this? Well, here's the chart you need to worry about. And I took some snapshots of it. So let's see if I can find those. So here we are. What I've done is I've put the crypto total market cap and the market cap of USDT, just to make something that's probably a reasonably obvious point super obvious. And that's when the things don't look great for crypto, money moves into Tether. That should be fairly obvious. And you will note that the crypto total market cap was absolutely running from October into the highs of 21, and the Tether holdings was down and then squared. Then you had a spill, literally, let's hold that in, a spill from there into these lows here, particularly those two candles. And as you can see, you saw a spike in Tether for those two candles. You might not see them, I'm covering them with a fat line. Then you got a top out in Tether around about there, and you came down. You can see that's where you got your 69 run with a little zig and a zag on the way down. In the same way, total market cap, zig and zag. So by now you should be appreciating that these are totally inverse relation. Down here, that's a localized low. You can see that's a localized high. Then you get another localized high in market cap, that's a localized low. Then you get a big move into Tether, and you get an absolute spiller on the market cap. Then you get a correction there, you got a bit of a rally, you're at a low. Then you ground higher into Tether, and you ground lower into the total market cap lows, which coincides with Bitcoin making around 15,500, those lows at the beginning of the year. So we then had a base here on Tether. It's quite a well-established base. And actually what we're talking about is there's a bit of a squeezy Japanesey getting super low vol over here under there. So my question is, could you still get a sell-off to come like this on the total market cap? Could we still get after failure? Now on the total market cap, that didn't even make a marginally higher high. This was your highest point, in the same way as that was your lowest point on the Tether over there. Since then the Tether went higher, that was its highest point, and that you can see was your lowest point. So totally inverse proportional. So now I'm going to take you into the lower time frame where we just have this pattern over here. And this is my primary concern for crypto, and the possibility of a demand destroying event that could do real damage, that could kill the inverted head and shoulder even, and get a W dip or maybe lower on the charts. So that means some of the bears could end up turning out to be accurate if it were to occur. It's not a prediction, it's a possibility. So you could get something like this. You cruise along here, and then you go along, and then you end up with another double dip like that before you go up again, or you could even risk running a new low. And that would invalidate the head and shoulder that was drawn on Bitcoin, not on total. Recognize that this is total. There's a lot of dead weight altcoins that haven't done what Bitcoin's done, or the top 10, 15-bit altcoins have done. And then there's the odd high flyer in there as well. So bear that in mind, but total has everything in it. If we just go total 2, it'll just have Ethereum in it as the dominant token, and you can see that total 2 in some senses has done almost less well. So if I just bring it down, you're actually struggling a little bit here on total 2. If we take Bitcoin out, you're struggling even more. That said, low vol, you had a reasonable up move, and then you've got 3 spinning tops. Typically you could see a surge there generally, but I'll be showing you why I'm not so sure you're going to get that this time. So total 3 is of course excluding Ethereum and Bitcoin, and you can see there's a lot of barely out of the blocks alt tokens. Don't forget, this will have the likes of what XRP recently did in it. They would be included in that. In fact, XRP would be the biggest. BNB would be probably the second biggest by market cap in the total 3. So these are even lower by nature. We have stopped going down. This could be more interim. However, if this were to turn into a break, so for that we go back down to the 2-dayer and we refocus. These are all alerts. Sorry for the black lines. We've got to have them. These are real alerts. So I've shown you on the weekly what the structure is. Let's just show it to you one more time. This, my friends, has a target right up by 12.5. 12.5. Now I just want to show you, before we leave this, I need to go back up bigger time frames. 12.5% on crypto USDT would mean devastation for overall the markets generally. I can highlight what happened. Let's just go weekly, not monthly. When you gained 5% from around here, which is around 44k, you went from 4 to 9, 4.7-ish to, in fact, right down here, you're around 3.8. 3.8 to 9.5. So call it 4 to 9.5. That's about 5.5%. That 5.5% move coincided with, my friends, Bitcoin at 40, going all the way down to low 20s. That 5.5% gain in Tether translated to approximately a halvening in Bitcoin, which was worse on your favorite alt. So you should be wary of a potential Tether dominance surge to the upside. Now, is this the most beautiful structure I've ever seen in my life? Probably not. Took a long while on the ups, came really hard down, but it's clearly very well supported at the 6.5 level. You've got your third and super low vol, generally bullish. You could see upside from here. So I'm going to take you into that particular piece of price behavior in this low volatility so you can see it on a lower time frame. So let's go daily. There's that low vol. Let's go 8 hours, shall we? So we are looking at Tether dominance. And what do we see? That's what we see, my friends. And that's when I saw, my God, this is breaking. I'm not sure I want to ride that. Now I will highlight that you then got rejected quite ugly. But while you were going up for that break, you were spilling and skidding down over here. You can see you went up on crypto total market cap as the Tether holdings went down. But this is a complex left shoulder. We teach you all about this, book a call, link below, and we implement it live in the market. So you have small shoulder, bigger shoulder, and final shoulder. So you've got all sorts of shouldering, all tapping out on the 7.425 neckline that we drew, and then you get, we call that point 1 and point 2. We shrink wrap the head like Jeffrey Dahmer did with his victims. We're kind of nice that way. And you get the 2 armpits. This is 1. So it's quite typical when you have complexity in the shoulders for it to be the same on both sides. So this doesn't mean it's failed. It's just going to create another possible shoulder. It could. It's not going to. It could. So the overall structure here is a real risk if we get above 7.43. That little reversal for us will take you to 8.06 alone. 8.06 alone starts taking you to our traditional entry on the upside for the 12.5 run. See that green line? It'll walk you towards that, which is a triggering event for a 12.5% run on the bigger time frames of weekly. If you want to see this in more detail and how we did it and where all the targetings come from, that you've got to learn from. And us at themarketsniper.com, go book a call. This is a confluence of targeting, by the way. So lest you think there's just one thing that gave us that level, we actually have a confluence of targeting. In short, we have a W bottom with a 4.9. Again, clear level of significance, interface there, and there. Small little wee shoulder after you got that little dip and touch there. But this is mainly a W, and that is our selected neckline of 4.9. And the target for that is confluencing with our HVF target to the upside. And can I highlight the relative highs for this tether was not good times for crypto, even though that was the bull market. The relative lows coincided with the high, 69, The blast off in Tether there, just before it was the high of 64, and then this final low of that shoulder was the localized high, and then everything to this move was just pain and misery. So, Tether is not your friend growing in dominance, in my opinion. Could some of it be soaked up by the death? This is Tether that's gaining, of other stable coins flooding into Tether. It could be part that, but I think it goes with a crypto contraction as well. So that is why we are looking at this, and this is contrary. We've been bull for a while. We've said it's probably likely you've turned for a while. We've said the head and shoulder is good for a while, but eventually you need to make progress. If Bitcoin does not come out screaming much more than it has done so far, by Monday or Tuesday after the non-farm payroll, and doesn't look significantly better, there is cause for concern. If it is still gestating, let's choose a relatively quieter chart than my usual busy stuff. This is cause for gestation. You have to start thinking about other structures, maybe like that, and the possibility that at some point this basing, ascending grind line along the lows, which is kind of steep, needs to be relieved with a breakdown of some form, and that this is not going to be a straightforward bull market. Remember the run to 14K? Everybody to the moon, $1 million, 150,000. Max Kai's at $250,000. Woo, 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 here we come, here we come. We did the big time frame macro on that, and we said shooting stars, it's going to turn, it's going to turn. Do not trust it, do not trust it. Everybody to the moon, to the moon, to the moon. And that's what happened. You remember that? Wicks, shooting star 1, shooting star 2. We said get out, get out, get out. Down, 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 small bounce, COVID dip. Next thing, 3.8 when you were previously 13.7. It wasn't quite 14K, 13.7. 3.8, 13.7. 3.8, 13.7. Yep, that's a little bit of 10,000K missing. Yep, as you can see. So the big time frames pay. This is a little bit soft and might need a wee rest. How does it do? It's rounding out a little bit. May need to have a little bit of a pullback. Even when you're looking at it on this time frame, under this viewpoint, you can see that that is starting to look marginally higher highs, a little bit like a banana. And we spoke about bananas when we were calling these loss of mentions. Oh, talk about my banana. Yep, oh boy, it's just the way it bends. So anyway, yeah, that is what I've got for you on crypto. So slightly more cautious, low vol, mega data week this week. A key move of high volatility is likely, and it could be downside. It could first be a down dip and then a surge up. It could be a pop up and a fizzle down. So the first move won't necessarily be the right move either. When the non-farm data comes in, the initial reaction is not necessarily the final reaction. I warn you. You can come and see this in by joining us for our live trading day. Go and check my Twitter feed. I am posting it. It has a gray image with the green luminous thing. You will see it on the Market Sniper. You will see it there. And I will retweet it after the calling of this video. By the time you're watching it, you will see. You can see this great number in. Even if I look at the big time frames and we look at this just super macro-ish, what you've essentially had here is a big falling wedge, a breakout, and then some loss of momentum and some real low vol, which could mean dip and run. It could mean dip, bounce, and you know, make some lows and muck around and take a while about coming back. It could mean initially a run and then a dip, the opposite of that. I'm not sure we just go melt up to the moon out of here. I think we need a bit of winding up. We've had that opportunity to do it. Some people will be looking at this rising wedge. So, you know, this could bring someone like Gareth Soloway's scenarios back into play with that, and he'll deserve some credit for it if it happens. But we've made money to the upside. We made some money on XRP. We made fairly well. So we've enjoyed trading the daily stroke 4-hourly time frames. But over the longer time frame view, this is a very key month. It's a very key month. However, I do expect gold and silver to be breaking in roughly the end of August to September and possibly before. If that comes, I think any down sell on crypto will be rescued and you will start to win again. You have August, I think it's the 20th, the BRICS nations talking about their planned currency and a bit of hoopla. This is going to put some pressure on the dollar again. In short, you want dollar pain. Bitcoin and crypto friends, you want dollar pain. Understand the macro matters, you want dollar pain. I have now shown you today the reasons why I think we are in a recession and that the markets will sell off at some point, meaning both the stock markets will also at some point, that people are in more pain than they consider. We've got a numbers week. We'll see whether that labor number holds up. I've shown you why palladium is a great indicator for where you stand in various economic crises. I've shown you that the dollar has been brought again under question, specifically the debt markets. The debt ceiling shenanigans are not impressing the likes of Fitch. I've also shown you that there is inconsistency by the judges in terms of how they are viewing things and further obfuscation in crypto. So this still creates a cloud. There is room and scope for a down leg to materialize. We have also shown you that the bid spreads between corporate bonds and the Fed's rate over here is actually a dangerous indicator for a correction too. We also showed you that the equity markets is ignoring the fact that there's real stress in the debt markets, and the two do not exist forever in parallel universes. The other one will be forced to comply. The liar is the equity markets. The more dominant, bigger, smarter mover is always the debt markets, in my personal opinion. So we've shown you quite a bit. There's that palladium show. We'll come back for these punks on another video because this one's already been too long. The BlackRock CEO and all the WeWork clans and the cults of this brain donkey here that you see here. Oh my God, these fraudulent pigs. There's so many of them. We've got so much more to talk to you about, but never mind. We'll catch you later. Don't forget, live trading day with the crypto and the market sniper. Watch the data come in. We'll have more clarity because actually I'm up here saying, hey man, it just looks like time for a bit of a crash in a combination of both the debt markets, bond market rates going up, a lot more pain being felt. That can't be good for crypto. Obfuscation by judges can't be good for crypto. But on the other hand, the dollar index was stopped in its tracks as a result of Fitch saying, you got too much debt. That's good for alternative money systems, gold, silver, and everything else. So it's going to be choppy and very volatile potentially. Be careful out there. You can see it in with us on Friday. You can book a call in the meantime. Thanks for watching, and thank you for subscribing and liking as well. Bye for now.